Meantime, the Federal Reserve is kicking off its two-day policy meeting today, where the central bank is expected to address its strategy on balance sheet normalization. Joining us now, CIT Fixed Income Senior Vice President Bryce Doty. Great to see you, Bryce.
Great to see you.
Your expectations on the Fed announcement tomorrow, and also what we may hear from Mr. Powell in the presser.
Right. We know they're not going to raise rates. Everything's going to be focused on their balance sheet reduction plan. And I think the market is pretty much expecting that they're going to say, hey, in September we're done. But I don't think it's that simple. And the devil will be in the details. Will they taper before they stop? How will they reinvest their maturities of their existing portfolio once they have stopped reducing the balance sheet? Those are things they're going to be really focused on. I'm nervous that the equity market is a little too optimistic about what's going to happen. When Powell testified in front of Congress last month, he said, it seems like $3.5 trillion is the right size on the balance sheet, and they're currently at $4 trillion. In order to get from 4 to 3.5 at the current pace, it still would take a full 12 months. So I think the stock market might be a little too optimistic about what they're going to say tomorrow.
Wow, that's an interesting point of view, because it seems like the markets were disappointed with the Fed at the end of last year, too many rate increases, and then the balance sheet normalization seemed to be on track. It seemed to at least meet expectations of being reasonable, that it wouldn't cool this market off too much. So what it sounds like I'm hearing from you is that the devil is in the details.
Right, and they will probably taper. If they do taper to kind of slow it so they don't just go cold turkey on the balance sheet reduction, then it could even take longer. So I don't know if people are going to be happy with that, or they're going to be even more surprised or disappointed by that. And then as far as how they reinvest the money, I think that after they got to the right kind of balance sheet size that they want, I think they're going to start reinvesting maturities into shorter bonds. I think they want the curve to be steeper. So they want to drive down short-term yields and stop buying as much longer treasuries, hopefully. So I think they're just tired of having to deal with the question of, hey, an inverted yield curve promises recessions. And that's got to be getting old to them. So I think they're going to want to re-steepen the curve. And it'll be interesting to see if they get into that kind of detail tomorrow. Let's
talk about the investor psychology here, right? Because we've seen different reactions to news. Sometimes, investors will say, okay, they're taking longer to unwind the balance sheet. That means they don't necessarily think the fundamental health of the economy is as strong. But, they're keeping the punch bowl spiked. So the market will go up and say that's a good thing. But sometimes when the market is feeling a different way, it will say, no, the fundamentals are more important. And if the Fed doesn't feel confident to hit its targets on balance sheet normalization, well, that's more important. So which do you think the reaction will be tomorrow?
Well, that is the million-dollar question. It's a good news, bad news type of thing, where if they come out and they say, we really need to stop the balance sheet way before $3.5 trillion, people are going to be nervous, going to be like, oh, there is something wrong with the economy. But if they're too rosy on the economy, it looks like that it can handle a lot of balance sheet reduction, then that's going to make the stock market nervous as well.
Right. No one wants to take the punch bowl away.
Right. And then for bond investors, you got to be careful what you wish for. OK, you don't want a dovish Fed. All right. If they take their eye off the ball and inflation starts to ramp up again, it's going to be bad for bonds. Long end will go up, and they probably do want that. They probably want, like I said, the curve to steepen. So they're okay letting inflation fears kind of get reignited at some point. And I think the second quarter, usually we see a weak first quarter, or a little bit of a rebound in the second quarter. And so, we're nervous that rates might start ticking up in a couple of months if it looks like the Fed's too dovish.
Okay. And with respect to the inflation target of roughly 2%, what are your thoughts on Powell's commentary around that target and the potential for rethinking it?
Yeah, he doesn't seem nervous about letting the economy run hot, does he? It's just completely opposite from 3 months ago. From a bond investor perspective, like us, we're kind of like, wow, you just really change your spots all of a sudden, and it's a little bit concerning. We don't think inflation's bad right now, but if you see 2 consecutive months in a row where CPI, ratchets up 2 months in a row, it's going to spook bondholders.
Bryce, what do you think about the commentary the president's made about the Fed, who is supposed to work independently? It's possible for Jerome Powell to block out as much as he can, but he must feel some of that pressure.
And I think he did. I think when he got asked to dinner and they said they didn't talk about Fed policy, that
right,
means
and it was his birthday.
Yeah. I think it made an impression. And all of a sudden, he's like really dovish. And when he was asked about the Powell put in front of Congress, he basically owned it. He goes, yeah, we're very concerned about stock market volatility. And so I think that dinner did have an impact, even though it's not supposed to. I don't see how it doesn't.
Before I let you go, what did you think of his appearance on 60 Minutes where he sat with Ben Bernanke and Janet Yellen, his predecessors? Do you feel like Jerome Powell is up to the task here?
I like him. I think he's better, frankly, than his predecessors. He's more plain-spoken. He's easier to understand. Sometimes the others would talk, and you just scratch your head at the end like, I'm not sure what they said. So I like it. But he is in a very, very difficult spot. No Fed chair looks good when they're raising rates.
Yeah,
okay, it doesn't matter who you are. And so, and he has to, I think he believes that they printed too much money, but he has to be sensitive to the two people he's sitting next to before he can't really slam them too hard for that. But I think he's really glad that they're reducing the balance sheet, all of which is very, very difficult. But I like the fact that he has the backbone to be able to do it.
All right, Bryce Doty, great to see you. Thank you so much.